Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Mr. Jerry Mutimakulu. I'm the lead Acca tutor at Transcal Business School, which is another segment of Transcal Consulting Services. Okay. Yeah, in this week, we're going to continue with our Acca Audit and Assurance paper. That is the learning phase, and we're going to touch on professional ethics, audit, documentation, and quality control. In our previous, previous week, we get an introduction to this very important subject within the professional accountant's journey towards qualification, where we touched about the introductory part of audit and assurance, and we were introduced to concepts like the engagement, the nature of the engagement, various types of engagements, but we highlighted that there were two such engagements where we have got the reasonable assurance engagement as well as the negative assurance engagement. And we highlighted that the reasonable assurance is sometimes called the positive assurance engagement, where we are saying that the auditor or the practitioner would be giving a positive feedback to those who have hired him, where he says that the financial statements present fairly in all material respects the status of the affairs within the company. But we also highlighted the negative assurance part of it, where we say that in this case the practitioner would be giving a negative feedback in the form of nothing has come to our attention to say that, or to believe, or to conclude that the reviewed matter is not what it looks like or what it purports to be. Alright, so in this current week, we are going to move a step further into the area of ethics, because by the end of the day, auditors, like any professionals, they are required to behave in a certain way. And remember, we are Acca students, Acca members. By the end of the day, we have to abide by the rules of the governing body, the Acca. Okay, so this is much of it, where we'll be talking about what ethical behavior is expected, what governs ethics, what are they, and by the end of the day, why do they matter? Okay, then we go a step further into audit documentation to understand why audit documentation is important. Then we rest our case with the issue of quality control. Okay, so without wasting much of our time, let us go straight to the business of the day. Now, the Acca Code of Ethics and Conduct, normally called the Code, sets out certain fundamental principles about how its members should behave. It also recognizes how its members could be subject to certain threats which would compromise their behavior and suggest ways in which members can safeguard themselves against the operation of those threats. So, the code applies to all members and even students. Okay? It doesn't apply to auditors who are said to be in public practice, but it also affects those accountants in business, be they finance directors, financial controllers, or even account clerks. They are also bound by the Acca Code of Ethics if they are Acca students or Acca members. Okay? The conceptual framework approach to professional ethics recognizes that there are fundamental principles to be followed. They are subject, these are subject to threats. Now, when these fundamental principles or ethical principles are subject to threat, what it means is there should be some ways to safeguard against those threats. So this is the main purpose of this lecture. It's not an issue of just highlighting or telling the examiner that there are ethical threats that are going to exist in a particular engagement or in a particular setup. But you just have to tell the examiner that even though those threats are there, somehow we can mitigate their impact by doing the A, B, C, D. Okay, so you need to highlight the threats, but at the same time, you have to tell the examiner how you are going to deal with those threats. It's not an issue of if we are having threats, then we have to quit the work, we have to quit the engagement. No, it doesn't work like that, because by the end of the day, we have got a family to feed, we have got a job to go to tomorrow. So we need to find safeguards to ensure that we remain ethical, but at the same time, we continue to get money by the end of the month. Okay. Now, the fundamental principles, fundamental ethical principles. Okay. I need a pen here because I need to elaborate some of these things. Okay. Now, the Acca's fundamental principles are as follows. We've got what is called integrity. Okay. What integrity stands for is that accountants should be honest and straightforward in whatever they do. Okay. Especially when they conduct their work. They should be honest and straightforward. Alright, so which means that the relationship between the accountant, in this case the practitioner, the audit practitioner, okay, should be found to be having high standards of integrity. Okay, which means if they see something amiss, they should say so. Okay, they should highlight, they should let it or bring it open. Okay, they should say so, and they shouldn't try to conceal it. They shouldn't try to turn a blind eye. They shouldn't try to be ambiguous. They should state things as they are. So to tell it as it is. Okay? They should also be bound by objectivity. Okay? Objectivity in making professional and business judgments must not be compromised. This means that they shouldn't allow bias or conflict of interest or undue influence to determine their course of action. So there is no bias, no favor whatsoever. They should observe professional competence and due care. Okay, they must keep themselves up to date with legislation and recent developments. They shouldn't take on work which they are not qualified for or for which they have no skills. They must be diligent and careful. All right, so it's not an issue of just taking whatever job that comes by. You just have to ensure that you've got enough skills to do so, you've got enough resources at hand, and you can, by the end of the day, perform that work without compromise. Thus, being professional, you must also ensure that your skills are kept up to date. This is why you see that by the end of the day, accountants should observe, even if you become a qualified member, by the end of the day, you should ensure that you comply with what is called the CPD, the Continued Professional Development Program. Okay? The CPD. You have to ensure that you attend those CPDs, and they are actually mandatory. Every professional body has got its members bound by this CPD rule that by the end of the year or in every year, a member should ensure that they have their skills up to date through the CPD programs. Now there is this issue of confidentiality. All right, this should be respected. Because by the end of the day, you are going to get into a particular company. Being an auditor, you are privy to whatever secret information within that company. And you are not supposed to take that secrecy or that information which you obtained during the course of your duties to use it for your personal gain. Okay? This is related to issues like insider trading. Okay? Okay? Also issues to do with client secrets. Certain secrets should be kept as they are. Okay? For example, their competitive advantage, etc. You're not supposed to sell that information to third parties. All right? So you have to respect the confidence. You have to respect. You mustn't take advantage. Like, for example, you have seen that there is going to be a new director that is going to come into this particular company. For example, if your company is now going to have Mr. Elon Musk as part of the directors, obviously, if it is a listed company, the shares of that company are going to rise. So, if you are an auditor and you are just bound to be unethical, you are going to sell that information to your friends or to encourage them to buy the shares in this particular company, knowing that tomorrow the shares are going to be having their prices skyrocketing. So your friends are going to have the advantage of having some capital gains because Mr. Elon Musk is joining that company. That type of behavior is what is called insider trading. It is not allowed. It is unethical. So accountants should observe confidentiality. They shouldn't take private information for their personal gain. Another example of a legal duty to disclose information can arise if a member thinks that a client or a person they are working for is involved in money laundering. Okay? Here, what we are simply saying is that even if confidentiality is going to be respected, there are certain instances or situations or circumstances where the confidentiality rule is broken. This is when there is a legal duty, a legal or professional duty to do so. For example, the legal duty would be put upon the auditor if they suspect that their client is involved in money laundering activities. All right? Or there could be some professional duty where the auditor just feels that in the public interest, such things should be known, just for the purpose of public interest. All right, what do we mean by that? Okay, here we are simply saying that the accountant will be taking such steps to ensure that enough information has reached the hands of the public for their interest and for their consumption. Usually public interest is related to issues to do with the welfare of the public, their safety, and so forth. Okay? Even if the matter could have been required by legal or by legislation, you might discover that extra disclosure sometimes is very necessary for the safety and well-being of the society that has got some dealings with a particular organization which might happen to be the client to the auditor. Okay, so sometimes the auditor might find out that there is also need to make disclosures which are in the public interest. Okay, I think that is it. Then, lastly, there is this professional behavior. This requires accountants to comply with law with the law and avoid any actions which discredit the profession. For example, when you are trying to advertise your practice or you want to advertise your auditing firm as an Acca member, you shouldn't say that other members are bad or poor, but you are the best one, or other accountants from other professional bodies, they are not as qualified as Acca members. No, that one is not a required behavior by professionals or of professionals. They should behave in such a way that they are not going to bring disrepute to the profession or to the Acca itself. Okay? Now, threats to the fundamental principles. We have seen that we've got about 5. They are 5 fundamental principles, but those principles are subject to threats. Okay, they are subject to threats, and these threats are the self-review threat, self-interest, advocacy, familiarity, and intimidation. Ladies and gentlemen, you must be comfortable with these ones because they are going to come in your ACCA AA exam. So you must actually be used to them. They should be cast in stone at the bottom of your hearts. Okay? There is also another threat called management threat. Let us now go through these steps one by one. There is the first one, self-interest threat. Here we are saying, ladies and gentlemen, that the auditor might be pursuing certain things because there are some financial gains involved. Okay? He might, regardless of the fact that he has no skills, he might just accept an engagement because of the money that is involved. Okay? So there is some financial issues to consider. Okay? For example, if an auditor owns shares in a client, the auditor could be accused of wanting the client's profits to look good. So whenever during the audit, whenever he sees that something is amiss, there has been some creative accounting or there's been some fraudulent financial reporting, he is not going to highlight that or to disclose that to the shareholders of the company, because by the end of the day, he might fear that if the cat gets out of the bag, the public will know and the share price of this particular company will fall down. So he, being also a shareholder, is not going to let that information get out to the public. So he is subjected to self-interest. He is putting his self-interest first before the shareholders, before the public, before everyone else. So that's a threat to the fundamental principles. All right. So in this case, he is not going to be objective. He is not going to be objective. So objectivity has suffered. It's not going to be objective. Okay. It's not going to be objective. All right. There is also an issue of close business relationships. For example, if a partner retired from an audit partnership and then immediately went to work for a client, they could be accused of having lined themselves up for a job, and to do that, they perhaps did not do their audit rigorously. So when you happen to be what is known as a revolving door, issues. If you happen to be involved in these issues, the revolving door where the auditor becomes the client. For example, you've been working at Deloitte and Touche, and then you happen to audit the Tanga toilets, and because of that privilege, you ended up becoming an employee of the client. You know, when other people will be looking at your audit in the previous year, they won't be satisfied that you did actually the good job, because there have been some self-interest threats in there because you ended up becoming a client. How come now it ended up to be like that? Then there could be some inferences that you were not doing your work properly. Okay. Then close family relationships between the auditor and the owners or directors of the company they're auditing. These also lay the auditor open to suggestion that the audit has been neither objective nor independent, and that the auditor did not show the proper degree of integrity. Yes, there is also this thing called loans and guarantees from the client to the auditor. Sometimes audit clients lends auditors money. Okay, you need to give a very clear eye in those scenarios, because if the loans are being given at low market rates, I mean far much lower market rates of interest, then we might infer that something fishy is happening. But sometimes they are given at market rates, then we are not going to raise eyebrows. Okay. Also, if the client has given you the loan in the course of its ordinary business, for example, the client might happen to be the bank and they gave you the loan, we can't suspect anything by the end of the day. Okay. But however, if the client made some large loans to your firm which are not on normal lending terms, this would compromise the auditor's independence. Remember, the auditor is to be seen to be independent. On top of being independent, he should be seen to be independent. So if such things happen, then the public will lose confidence in the auditor. So those are the issues. There are also issues to do about overdue fees. Overdue fees, for example, you've worked at the audit client, but they did not pay you last year and you are supposed to audit them this year again. If you continue to work without being paid, there could be some inference that you are not going to do a thorough audit, not because you are bored, but because you fear that they are not going to pay you at all. So you're going just to toe on their line, which is actually a very bad thing. Then contingent fees. Contingent fees are that you might be hired. Let's say that you're going to be paid based on the outcome. Let's say the client is going to pay you if their profit rises by 5% this year. Such type of an arrangement is not allowed. Okay, that type of arrangement, no contingent fees are going to be accepted. If you accept such an engagement, there is going to be some self-interest to be inferred against you. High percentage fees. If the auditor earns a high percentage, let's say the auditor, Mr. A, is the auditor of C Limited and D Limited, okay, and also E Limited, okay. But if about 40% of its income is coming from C Limited, and then the rest 60% is coming from about 10 other clients, we can safely say that C Limited is actually a larger client on which A is actually dependent. Okay? Now, there are rules that cover this type of situation. If the auditor earns a higher percentage of total income from one audit client, then the auditor will rely too much on that client and can't afford to lose that client. This can give the client too much leverage over the auditor. The total fees from a public interest entity or client, the company that is listed on the stock exchange, should not exceed 15%. This is a multiple choice issue that always comes in the AA exam. Okay, if a client is listed company, the fee from that particular client should not exceed 15% of your company, of your audit firm's total income. Okay, for 2 consecutive years. It might happen in 1 year, but it is not going to be expected to happen in the following year. So, if they do, safeguards must be applied on the engagement, or the engagement is going to end. Okay? However, no figure is mentioned for non-public interest clients, but auditors need to be mindful of this threat. So this 40% here, you just have to be mindful of that. Okay, even if limited is not listed, okay, there is no rule that you mustn't continue having that relationship, but you just have to be mindful, because by the end of the day, if you are over dependent on a particular client, then there is risk that you are going to dance according to their tune, which is not good for an auditor. Then, lowballing. This refers to the practice of quoting a very low audit fee to win a client. Perhaps, let's say this particular client is going to give you more work in future. For example, non-audit fees. So you might say, it's better I just charge them low fees for the audit. Okay, this means really that the audit does not pay for itself, so how, therefore, could a proper audit be done? That's the question which can be asked by anybody on the auditor. Winning an audit is a competitive business, and the audit fee is an important factor to clients. There is nothing illegal about lowballing, and quoting a lower fee is not in itself unethical. However, an auditor could find it difficult to claim that a proper audit has been carried out if a loss were made on the audit. Okay? So, the issue of justification is going to be problematic if, at the end of the day, we have charged low audit fees and we discover that we made a loss in that audit. Justification that we did a proper, high-quality audit is going to be something difficult to come by. Okay. Now, self-review threats. Self-review threats arise when an auditor does work for a client, and that work may then be subject to self-checking during the subsequent audit. For example, if auditors perform internal audit services and then has to check that the system of internal control is operating properly, auditors could obviously be reluctant to criticize the work which their own firms have earlier on undertaken, and this could interfere with independence and objectivity. So self-review is another baby to worry about. Okay, you shouldn't participate in certain processes of the client which are going to be subject to your checking by the year end. Okay, for example, you might perform internal audit services, but by the end of the day, when you do your audit, you're going to check those processes by the internal auditors. Sometimes you discover that the internal audit processes which you undertook were not up to scratch, and it might be difficult for you to criticize yourself. This is the same situation here where you recruit staff for the client. If you recruit staff for the client, by the end of the day, if you discover that some of the staff members which you recruited were just incompetent, you might also find it difficult to bring that to the attention of the shareholders. Therefore, you're going to come up with a very poor audit. Advocacy threat. Advocacy is when the assurance or audit firm promotes a point of view or opinion to the extent the subsequent objectivity is compromised. For example, you might be asked by the client to promote their financial position to a banker. They might say, we are going to host a meeting with ZB Bank or CBZ, so we want you, our auditor, to be present so that you give the bank manager some confidence in us that we are a good company. Such type of a situation is what is called an advocacy threat. It is not allowed, as it interferes with professional skepticism. As always, the audit firm should weigh up the risk to its objectivity, integrity, and independence, and should withdraw from performing further work if those risks are too high. If you have seen that all management are so much devoted into you advocating for them, you just have to consider quitting the engagement. Familiarity threat. This is the threat where the auditor becomes too familiar with the members, with the client. Okay, the close relationship can arise by friendship, family, or through business connection. Let's say your son marries the chief finance officer's daughter. Okay, obviously the familiarity threat is high there. There is no general definition of what is meant by close relationships, but if you were an auditor and your brother was the finance director of a client firm, then there probably is a close relationship. If, however, the finance director was a remote cousin of yours, there might not be a close relationship. Note that there does not have to be any family or legal relationship. Friendship can threaten independence and integrity. Long association of senior personnel creates a familiarity and self-interest threat. The code requires that a key auditor partner cannot serve a public interest client for more than 7 years. We are saying here, this public interest is actually an issue. Okay, public interest entity. The pie. These are the major issues to do with our auditing and assurance subject. Okay, they are going to be a thing in our flesh. We're going to meet them, and by the end of the day, because the accounting profession is all about public interest, and I say that public interest has to do with the public welfare of the public, safety. Okay. By the end of the day, auditors, like any other professional, they have to safeguard the public interest. Okay, they have to safeguard. So, public interest entities, these are entities which are listed. The reason why they are called public interest entities is because the ownership is actually open to the public. When you go on the stock exchange to buy shares, you believe that the stock exchange is is a good and safe market because it is a regulated market. The participants there, they are responsible participants. Okay, so this is why the public has to be safeguarded, because they shouldn't buy things which are time bombs. They shouldn't invest in firms which are going to crash tomorrow or overnight. So their safety has to be guaranteed. All right. So please bear in mind that if you happen to be a partner, okay, an audit partner, a key audit partner, okay, for a public interest entity, you shouldn't be a consecutive partner of that entity for more than 7 years. All right. This is to prevent, okay, the too close a relationship and friendship between the audit firm or between the partner himself and the client. Now, intimidation threat. This is the final group of threats, okay, and it can deter the assurance team from acting properly. Examples could be threats of litigation, blackmail, or they might even be physical intimidation, though it is to be hoped that this is very rare. Blackmail could be more subtly applied. For example, if a gift or hospitality from a client were to be accepted, the possibility of that being made public would create an intimidation threat to objectivity. So this is the issue of blackmail. Some clients might insist that, hey man, oh please just take this 1 ton of sugar, because it's, for example, in Zimbabwe, sugar is becoming a problem. There is a gross shortage of sugar and other basic commodities. So when you go to audit a client, let's say you're an audit senior or audit manager, you go there, the managers say that, hey man, Mr. Audit Manager, can you just take 500 kgs of sugar, yeah, just for your family, okay? But if that gift is made public, obviously there is going to be the issue of blackmail, okay? Or once you take that sugar, you put it in your boot, and the finance director say, if you do not come up with an unmodified, okay, opinion or an unmodified report, then I'm going to expose you. That's blackmail, isn't it? Yeah. There could be some intimidation, all right? You'll be intimidated. So you're going to dance according to their truth. Sometimes intimidation might come in the form of time pressure, okay? Time pressure. The management of the client might say, hey, we want the audit report in 2 weeks. So may you please start your audit now. How can you audit 10 branches, okay? 10 branches and of high-end supermarkets, 10 branches of high-end big supermarkets, and they're saying that you just have to audit everything in 2 weeks. All right, you have to do everything in 2 weeks. Then there is time pressure, and that is going to actually be an intimidation on your part. Okay, now we talked about management threat. There's also something called management threat. Management threat is usually common among experienced auditors. Okay, the client might say, you guys from PwC, you are experts in the audit field and in accounting in general. Can you please assist us? Okay, can you please assist us in evaluating our project? We are intending to do a project, so can you please use your skills to help us come up with the better deal or the better choice to take, the better course of action to take. That's a management threat. Okay, they are imposing management responsibilities on you as an auditor. You just have to tell them, okay, just have to tell them that even if you assist them, the responsibility should be there. Okay, the responsibility to make the final say should be there. Otherwise, you just have to decline. Okay, now offering other services. The issue of whether the auditor should provide audit clients with other services such as taxation and management consultants is a controversial one, as they are both pros and cons. For example, auditors will know a great deal about the operations of their client, and this can make the performance of the work much more efficient. If entirely new firms have to be brought in to supply these services, much of the information they find out about the client will already be known by the auditor, and there is a real duplication of effort. The provision of non-assurance services will create a self-review threat. For example, bookkeeping, internal audit, track computations, and evaluations material to the financial statements. All right, so we are saying that when the auditor is doing bookkeeping, but at the same time is doing auditing, by the end of the day, there is what is called self-review, because he's going to check the work he did himself. So there's going to be some self-review. So there is a danger in the offering of other services outside auditing to one or to similar clients. Another danger, of course, is that the auditors come to rely too heavily on the fees earned from the other work and are therefore reluctant to risk losing a client if they express a modified audit opinion. Okay, large audit firms can at least use separate departments, though this may be difficult with small firms. Okay, so we are seeing a situation here where because if they don't do these non-audit services, they might end up over-relying, okay, on the, if they offer these non-audit services, they might end up over-relying on their clients or on a particular client. Okay, so they will be exposed to a self-interest threat. However, large firms are mitigating this by having separate teams attending to these non-audit services. So you might be having the key audit team, okay, separate audit team, and then having the the other teams for internal audits, for bookkeeping, etc., so that the issue of self-interest and the self-review threat is minimized. All right. So sometimes the examiner might ask you, what are the implications of offering other services or non-audit services? The implications are that there could be some self-review threats because we are going to check the work which we did. Okay, there is also the issue of self-interest because we are going to be heavily dependent on the client in terms of income, because they're going to give us audit fees, they're going to give us income from non-audit services. That, at the end of the day, would force us to be heavily dependent on a particular client, which would be a self-interest threat. However, we can mitigate that situation by sending separate teams. But that one is an option for larger firms. What about smaller firms? How are they going to survive? In the US, listed companies are not allowed to obtain other services from the auditor. This is to ensure that the auditor is independent and performs only the audit. In most jurisdictions, there are no hard and fast rules, but offer guidance on ethics relating to objectivity and independence should be adhered to. So, the offering of other services is outright prohibited in the US. However, in other jurisdictions, we just have to abide by the principles of objectivity and independence. Those should guide us. Now, let's talk of the safeguards. Applying safeguards may be a suitable response to address an identified threat. Other responses are to eliminate the source of the threat or decline the activity. The Acca Code of Ethics 2019 defines safeguards as actions, individually or in combination, taken by the professional accountant that effectively eliminates threats to compliance with the fundamental principles or reduce them to an acceptable level. A professional accountant's action is not a safeguard unless it is effective. Okay? The test of what is acceptable is whether a reasonable and well-informed party would be likely to conclude that compliance with the fundamental principles is not compromised. Safeguards vary depending on the facts and circumstances. Examples of actions that might be safeguards to address threats include assigning additional time and qualified personnel to mitigate the self-interest threat. Okay, you just have to assign more qualified staff or to devote our time to understand more about the client. Let's say the client is changed his systems radically or they are completely a new client. We need to devote more time to know them, to know how they do their business. That might mitigate the allegations of having a self-interest threat. Having an appropriate reviewer, not a member of the team, review the work performed for a self-review threat. Sometimes you might have another partner on the side who is going to review what the other partner has done. Using different partners or engagement teams with separate reporting lines for the provision of non-assurance services to an audit client for self-review, advocacy, or familiarity threat. This is actually good, but as we have already highlighted, it is usually done by larger firms, where for non-audit services, there will be some separate teams, and for audit services, the other teams. Involving other firms, another firm to re-perform part of the audit engagement for most threats. This one is expensive, but it is also good where it is expensive in the sense that we are going to have the lion's share on what was supposed to be ours, but we can end up using other firms to help us doing some of the work. But remember, the auditor is going to be one person, okay, who is going to take the responsibility of everything. There could be some dangers in actually involving other people who might end up destroying your reputation when they do the bad work. Disclosing to the clients at any referral fees. Disclosing to clients any referral fees or commission arrangements for recommending services, products for a self-interest threat. So we have to disclose to clients, okay? We have to disclose to clients for any referrals or commission arrangement for recommending services or products to ensure that we limit the self-interest threat. Separating teams when dealing with matters of confidential nature for self-interest threat. Sometimes there could be need to have separate teams when we know that a particular issue require some some observance of confidentiality. Okay, as an elaboration on this one, let's say you happen to audit a competitor. Okay, auditing a competitor. Okay. Let's say you are auditing H Limited. However, there is also a new company that is S Limited or P Limited. Okay, H and P Limited are competitors. All right. So you're now auditing a competitor of your client. There is need to ensure that separate teams are deployed at these clients. Not one partner is going to be the auditor of both. That might create issues to do with confidentiality. So there is need for you to have separate teams there. Now, how do we obtain audit work? How do we obtain clients? Members are entitled to advertise their services and products. The advertising medium should not reflect adversely on the member, Acca, or the accountant's profession. Adverts should not bring Acca into disrepute or bring discredit to the member, firm, or accountant. I once passed by a certain advert that was saying that I am the only Acca member in town. I am the only Acca member in town. Who knows how to manage tax for clients. If your tax return is rejected by Zimra, I bet with my life. Such type of advertisements, they are what are called bad advertisements. Okay? They are not allowed. You shouldn't make some unsubstantiated claims. You shouldn't bring disrepute to the profession or even the Acca itself. Claims like the Acca is the only professional body. Having an Acca auditor, that's having a quality audit. That's an unsubstantiated claim. That's a very bad, it sounds very bad on the Acca as well as the accountant's profession. So you mustn't have an advert that discredits the services of others. There are other professional accountants in the market. They should also find a space to do their business. There shouldn't be any noise in the business arena. The advert shouldn't be misleading. It shouldn't fall short of local regulatory or legislative requirements. Please note, lowballing is not encouraged, and if one does it, he has to ensure audit quality is not compromised. Sometimes in your advert you might say, we are going to charge you very low. It's allowed, but make sure that when you charge clients low fees, you're not going to compromise the audit. The audit should be done in terms of ISAs, in terms of international standards on audit. How can companies reduce external audit costs? Companies can reduce external audit costs through various legitimate measures. For example, extending the size and function of the internal audit. Okay, clients can actually negotiate and say, hey man, we have hired you as a regulatory requirement that we should have auditors, external auditors, do the job here. But look, we are having our own internal audit function. Can't you at least go down with your fees, because much of the work these guys are doing. Reducing the number of different audit firms used worldwide. So the companies, especially the multinational companies, can actually opt to have very few audit firms to hire, or just hire another multinational audit firm for that matter. Selling off subsidiary companies, leaving a simplified group structure to audit. Okay, companies might sell off subsidiary companies to ensure that their group is as thin as possible. The tender process itself simply makes auditors more competitive. So companies, if they follow tender procedures, advertise for tenders for auditors to bid, okay, by the end of the day, the auditors in that tendering process might be forced to become more competitive and not becoming too expensive to the companies. So that makes the audit services more competitive and more cheap. Exchange rate fluctuations in audit fees. Sometimes it becomes cheaper to pay for an audit where exchange rates fluctuate, okay, as in the case of countries like Zimbabwe, where an audit fee that has been charged at the beginning of the year might become cheaper by the end of the year because of exchange rate fluctuations. Okay. Now, the issue of appointment. Okay. Before a new audit client is accepted, auditors must ensure that there are no independence or other ethical problems likely to cause conflict with the ethical code. Furthermore, new auditors should ensure they have been appointed in a proper and legal manner. We discussed about the appointment of auditors, etc., in our previous lecture. Now, the nominee auditors must carry out the following procedures. Now, when you have been nominated, you just have to do what are called acceptance procedures. Okay, you just have to ensure that you are professionally qualified to act or to become their auditor. All right, so you have to consider whether you can be disqualified on legal or ethical grounds. You need to ensure existing resources are adequate, your resource pool. Consider available time, staff, and technical expertise. So these are very important issues. You have to obtain references. Make independent inquiries if directors are not personally known. Just have to make some, know your client due diligence issues. Okay. Communicate with the present or the outgoing auditor. The outgoing guys, you have to communicate with them. Inquire whether there are reasons or circumstances behind the change which the new auditors ought to know. Also, do that as a courtesy. Okay, you just have to approach the current or outgoing auditors to know more about this client. You also have to do that for ethical reasons as well as for courtesy. Okay, ethical reasons in the sense that sometimes the client have just chased their auditor. They've just chased them because they were too observant. Okay, so they just want a dull, money-loving auditor who cares nothing for the future. So just have to at least approach those guys and learn more about your new client. Otherwise, you are going to throw yourself into deep mess. So this is an appointment decision chart. Okay. Firstly, you are approached by a new audit client. Okay. Just have to ask this question: is this the client's first audit? Okay. If it is the client's first audit with your firm, then no need to follow professional rules. The auditor can make own decision. All right. But if the answer is no, you just have to ask this question: does client give permission to conduct auditor? A very important issue here. So the relevance of, is this the client's first audit, is actually a very, very important one here. Okay. Suppose this particular client has never been audited at all. If he has never been audited at all, you then have to go this way. Okay. There won't be any need for any professional rules. You just have to use your own professional judgment whether to accept or reject. However, if these guys have been audited, you then have to ask, does client give permission to conduct auditor? If they give us permission, then follow this route. We have to write for all information pertinent to the appointment section. Okay? Then we need to ask, does client give auditor permission to reply? If yes, does auditor provide information relevant to new appointment? Obviously, they have to do that. Okay? They have to do that, because if they don't, if these auditors do not give you the information, just have to take this step. Give auditor due notice, then decide on basis of knowledge obtained otherwise. Sometimes, if they refuse to give you any information, just have to report to Acca. Report to Acca if they happen to be Acca auditors. Or if they are not Acca auditors, then you just have to report to a relevant professional body to which they belong, or to the local supervisory audit body. For example, in Zimbabwe, we've got the PAB, the Public Auditors and Accountants Board. Now here, does all the auditor provide information? If the auditor provides information, then you get the basis of accepting or rejecting this particular client. Then there is this here. We did not talk about it. Does client give permission to conduct auditor? If the client does not give you the permission to conduct the outgoing auditor, prospective auditor should decline appointment. You should not accept the engagement. Just have to decline it outright. Why shouldn't they allow you? There could be something fishy which they do not want the old auditor to tell you about them. Okay? Now, sometimes if the auditor does not give you the information, you also have to consider declining the appointment. Okay? If the client does not allow the outgoing auditor to give you information, it's two-way now. It's either the client does not allow you, okay? The client does not allow you to conduct the old auditor, we have to decline. Also, if the client does not allow the old auditor to give you information, you just have to decline. Okay? That's the thing there. Now, audit documentation. Why is audit documentation necessary? Audit documentation is necessary because of quality issues. For us to come up with a quality audit, we need to put everything, our evidence, in writing. There is what is called working papers. Audit working papers. Okay? Everything should be written. Alright? So, if we have got good quality audit papers of everything we have been doing, then we are highly likely to come up with a good audit, with a high quality audit. Okay, so having written evidence would provide us information or evidence for reference in future years. Okay, the audit team in subsequent years would be having some documents to refer to. When they want to know more about the client's processes, they will resort to the audit files, the working papers, and everything for more information about the client. There's also an issue of minimizing the errors, audit errors, because we would have written most of the things. There's also an issue of methodical approach. Okay, a methodical, high quality approach. Okay, remember, by the end of the day, we have to be systematic, not haphazard when we do our auditing. Okay, we just have to be systematic. So the issue of having some documentation, this helps us to be professional people who are systematic in their dispensation, in the way they do their audit. Now, we've got two types of audit files. We've got what is called the permanent audit file. This contains information that does not change a lot, such as description of the accounting system, names and addresses of the commerce, bankers, lawyers, the organization chart, memoranda and articles of association. Also, a history of the ratios used in analytical procedures will be maintained so that trends can be seen. So that's the purpose of the permanent audit file. It's part of the documentation. Now, we've also have got the current audit file. This contains the financial statements being audited and the details of the audit work that has been carried out to collect sufficient appropriate audit evidence about those financial statements. So, know the difference between these two files. Structure of the current audit file. The amounts on the financial statements are referenced to section of the file. Separate sections for non-current assets, inventory, receivables, payables. That's the structure of the current audit file. Within this section, the makeup of the figures are examined and the work carried out on each figure is recorded in detail on the audit working papers. Now, we have been talking all this while about working papers. What are they? Okay, they have got a structure. An audit working paper has got a structure. So it has got a title, whether it is a receivables working paper, or wages, or non-current assets, or let's say motor vehicles, etc. working papers. Okay. So that's the title, the date it was prepared, the person who prepared the paper and their signature. Reference to the schedules, okay? Whatever schedule, whether it was a depreciation schedule or it was a salary schedule, etc. Okay, the notes, the references should be given there. Purpose of the audit tests being performed, what audit tests and what were their purpose. Precise details of work performed, such as invoices examined, assets inspected, calculations reperformed, etc. Okay, what did you actually do? Then conclusion from the work performed, whether the receivables amount was correct or not. You just have to check, to write it down on the particular working paper. Reviewers' signatures and date of review. The reviewer is somebody who is of a higher seniority from the preparer, somebody who was to be a supervisor or a manager, etc. The audit supervisor or audit manager has to sign on your working paper to ensure that what you did was actually up to scratch. Now, this is the last issue we are going to talk about, the quality control issue. International Standard of Auditing 220 quality control for an audit of financial statements state that quality control systems, quality control policies, and quality control procedures are responsibility of the audit firm. So each audit firm has to ensure that it has got sound quality control systems, quality control policies, and quality control procedures. These three should be the responsibility of the audit firm as a whole. The audit firm as a whole. The objective of a system of quality control is to provide reasonable assurance that the audit complies with professional standards and applicable legal and regulatory framework or requirements. Reports issued by the firm or engagement partners are appropriate in the circumstance. Note the use of the word system. You will know that firms have to ensure that, for example, no one involved in an audit owns shares in the audit client, and that fees from any one client must not be too great. But these safeguards cannot be left up to chance. Auditing firms need systems in place that will ensure that ethical codes are not broken. Systems also provide evidence that quality has been maintained. So an audit firm should also have proper systems to ensure that what is considered professional practice is actually cast in stone. There should be some work policies in each auditing firm where all audit team members, to which all audit team members should abide. For example, each year, every member of the audit staff could be required to sign a declaration that they do not own client shares. Each year, a partner should review fees and sign a declaration that fee limits have not been exceeded. Okay, so that's the issue of policies, okay, and procedures. In some organizations, or audit firms, they've got what are called routine orders. Okay, they have to be signed to ensure that every member at that particular firm or organization is aware of those orders, and they have to be complied with. If a member is found to be deviant, then by the end of the day, they are put to disciplinary action, because that's a breach of a routine order. Now, quality control requirements. Quality control requirements. There's an issue of leadership. The engagement partner is responsible for the overall quality of his audit engagement. Remember, we are talking of audit firms here. This is not quality control for clients. Not. We are not talking of quality control in clients. We are talking of quality control within an audit firm. So the overall leadership is the responsibility of the audit engagement partner. Okay? Ethics. Throughout the audit engagement, the engagement partner shall remain alert through observation and making inquiries as necessary for evidence of non-compliance with the relevant ethical requirements by members of the engagement team. This is why we first discussed about the ethical issues surrounding the audit environment or surrounding auditing or the accounting profession in general. Acceptance and continuance of client relationships and audit engagements. The engagement partner must be satisfied that appropriate procedures regarding the acceptance and continuance of client relationships and audit engagements have been followed and that conclusions reached in this regard are appropriate. So, the audit engagement partner should ensure that throughout the audit, everything is up to scratch. Okay, sometimes you could have accepted an engagement when the client senses was sound and well. But during the course of the year, you will discover that so much mess is happening with the client, and you just have to ensure that is it still palatable that we continue as auditors of this client. Sometimes, for example, there might be the management of the client might tend to be diabolical people, corrupt, with a bad name. So, in that case, you might decide to say there is need for us to decline to get out of the audit contract, okay? Because the occurrence, what is happening in this particular client, is no longer professional. Assignment of engagement teams. The engagement partner must be satisfied that the engagement team and any audit experts who are not part of the engagement team collectively have the appropriate competence and capabilities to properly perform the audit to enable an appropriate audit report to be issued. Okay? So, the engagement partner is to be satisfied. Okay? They have to be satisfied that everything is in place, including the team members. They have to ensure that they have got the necessary skills, including those experts who might not be part of the engagement team, but who might come or who might be called upon, should also be assessed to ensure that they've got the requisite skills, requisite competencies, and everything else. All right. Lastly, the engagement performance. Direction, supervision, reviews, consultation, and performance should be of a standard to enable appropriate audit report to be issued. There is also an issue of monitoring to ensure that the quality control procedures are properly observed. Okay. There is also an issue to do on this leadership. That is the point I have to highlight here: the conflict resolutions for management. The engagement partner is to ensure that disputes or conflicts that might arouse between the audit team should be resolved under his responsibility. They are his responsibility. He has to ensure that there are no such conflicts or deviations, and all the conflicts has to be carefully managed, okay, and well managed, rather, okay. They have to be well managed by the engagement partner, okay. Reporting channels should be clear, etc. All right. Public interest audits, such as the audit of listed companies, should undergo an engagement quality control review. Here, an independent reviewer, normally another partner, will be appointed to perform an objective evaluation of the significant judgment made by the engagement team and the conclusion reached in formulating the audit report. This evaluation involves discussion of significant matters with engagement partner. So this quality reviewer, okay, would be discussing with the engagement partner. The quality control reviewer would be discussing with the engagement partner of any significant matters that could have arisen throughout the audit or the significant findings, etc. Review of the financial statements and the proposed auditor's report. The engagement quality control reviewer would also have to review financial statements and the proposed auditor's report. Review of selected audit documentation relating to the significant judgments and the engagement team made and the conclusions it reached. So this guy would also do that. Evaluation of the conclusion reached in formulating the auditor's report and consideration of whether the proposed auditor's report is appropriate. So you can see that we are still having the pie, okay, the public interest entities at play. For audits of listed entities, the engagement quality control reviewer must also consider the engagement team's evaluation of the firm's independence in relation to the audit engagement. Okay, this is now a check of ourselves where we're saying that the reviewer would also assess if we had determined that we are actually independent to audit this particular client. Whether appropriate consultation has taken place on matters involving differences of opinion on other difficult or contentious matters and the conclusions arising from those consultations. Whether there was actually thorough consultation. When we were, for example, in areas of high objectivity, for example, issues to do with the fair values and so forth. The quality reviewer has to determine if such consultations have taken place. Whether audit documentation selected for review reflects the work performed in relation to the significant judgments and supports the conclusions reached. You can see here that the engagement quality control reviewer has got a very big task in determining if our audit documentation reflects the type of concentration, type of the type of effort expected of a quality audit. Okay, he can actually ascertain if we were actually serious about our work. Okay, if we had devoted more energy and skill and expertise as required in our judgments or in the judgments which we arrived at. So, an engagement quality control reviewer is an example of a pre-issuance HOT review. So, when we call upon another partner to review our work, we are actually doing what is called the pre-issuance HOT review. It is carried out before the auditor's report is signed. Any reviews carried out after the auditor's report is signed are known as post-issuance called reviews. They will not affect the audit for the year being reviewed, but they will help maintain or improve quality standards in the future. Let's say after we have signed the auditor's report, we then ask somebody to review what we have done. That type of effort is not going to change anything, but it is going to help us to know where we went wrong and where we did it right for future reference purposes. An audit firm may choose to carry out reviews, hot or cold, where an engagement quality control reviewer is not required. Now, the Acca Code of Ethics and Conduct sets out the 5 fundamental principles of professional ethics and provides a conceptual framework for applying them. And please do not forget, these are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Members of the Acca must comply with these fundamental principles. Although auditors have a professional duty of confidentiality, they may be compelled by law or consider it necessary in public interest to disclose details of clients' affairs to third parties. Threats to independence and objectivity may arise in the form of self-review, self-interest, advocacy, familiarity, and intimidation threats. Appropriate safeguards must be put in place to eliminate or reduce such threats to acceptable levels. The present and proposed auditors must communicate with each other prior to the audit being accepted. However, if the client refuses to give permission to the auditors, to the proposed auditors to make conduct, the proposed auditors must decline nomination. The terms of the audit engagement shall be agreed with management and recorded in an engagement letter. The International Standard on Quality Control, ISQC1, helps audit firms to establish quality standards for their business. ISO 220 requires firms to implement quality control procedures over individual audit engagements. Ladies and gentlemen, I hope we have done justice to this particular topic. I'm looking forward to see you do the assignments. Okay? Let's now do assignments. And remember, always make sure assignments are sent in by due date. Okay? The assignments have to be submitted by due date. And ladies and gentlemen, please feel comfortable to contact your tutor 24/7. Okay? This is the reason why you hired us. The objective was for you to sit relaxed, to enjoy the learning. Okay? Nobody should fail Acca, Audit, and Assurance. These numbers are for you, ladies and gentlemen. 24/7. 7 days a week. And 365 days a year. The Acca tutor is going to be there online. There's always going to be a tutor on call just for you, ladies and gentlemen, so that your journey towards Acca certification is going to be an easy one. Until next time, ladies and gentlemen, may you please feel very excited, very, very excited. Please, if you have enjoyed this video, please make sure you subscribe to the channel so that you get all the material that we have uploaded. Okay? Do not also forget to click the notification bell for you to be the first one to be notified of any new video that is come on this particular channel. Thank you very much. May the good Lord bless you.